Hi, everyone, and thanks for joining us today. I'm Delvin Youssef, and I'm excited to welcome you all to today's session on building trust in digital finance. For those of you joining us for the first time, Fingerprint is a foundational layer for modern fraud defense. Our device intelligence platform gives you a highly accurate lens to distinguish good visitors from fraudsters, no matter if they're human, bots, or agents. We make it easier for you to stop attacks and stay ahead of new threats from AI. Before I hand things over to our speakers, I have a few housekeeping items to cover. If you have any questions throughout the session, feel free to drop them in the Zoom Q&A box below, and we'll leave time at the end of the session to answer as many as we can. Today's session is being recorded, and a copy of the recording will be shared with you after the webinar. And if you would like to enable closed captioning, you can do that at the bottom of your Zoom panel. And presenting today's session, we have Emma Spellman, our FinServe industry marketer. So Emma, I will hand it over to you.
Thanks so much, Delvin. Really appreciate it. I am Emma Spellman, Industry Marketing Manager at Fingerprint, and your host for today. Our guests here are Nikita Konopaski, Product Owner, Fraud Detection at Deutsche Credit Bank, DKB, a digital-first bank based in Germany, serving roughly 6 million customers, and Peter Daunton, Chief Product Officer at Sokin, a global financial infrastructure company operating across 170 countries. Thank you so much to you both for joining us. With that, let me share the agenda for you guys. Really excited again for this webinar. First, we will learn more about our guests and then go into the state of digital finance today, then narrow down on some additional questions for our guests, and finally go into some audience Q&A if time allows. So with that, let's learn a little bit more about our guests. I will start with you, Nikita. If you could please give the audience context on your role at DKB, what has changed in the banking and threat landscape firsthand, and because of that, what you prioritize today.
Sure. So I'm a product owner at DKB, where I lead a team responsible for fraud detection. And I work closely with data scientists and engineers who build and operate our own machine learning models to identify and stop fraudulent activity across the bank. And I've been with DKB for about 8 years, so I've had a really front row seat to the threat landscape that has evolved. And what has changed most is the level of sophistication, I would say. So fraud is no longer just about stolen credentials or simple attacks at scale. Fraudsters are using highly convincing social engineering, using new technologies, and adapting faster. And at the same time, customers expect payments to be instant and seamless, which leaves much less time to detect and stop fraud before money moves. And because of that, one of our biggest priorities today is account-to-account fraud, especially in the context of instant payments. And the challenge is finding the right balance between protecting the customer and building trust while still delivering the fast digital experience they expect.
Great, thanks, Nikita. And that's absolutely the theme for the webinar today. And Peter, same questions over to you.
Yeah, thanks, Emma. And nice to be here. Nice to meet everyone. I think it's been about a year since I was last on a webinar with you guys at Fingerprint, so mustn't have done a too bad a job because you've invited me back. So nice to be back. So yeah, I'm Pete. I'm the Chief Product Officer at Sokin. Sokin, as Emma mentioned, we're a global financial infrastructure company. And what that means is we do everything to support businesses who are going beyond borders. So we provide the ability to move money, to manage money globally, and we do that by unifying financial operations, intelligence, and access all through a single infrastructure layer. I'm based over here in the UK, as you can tell by my accent, and just as a word of warning, my son may charge in as he gets home from nursery. So if you hear some screaming in the background, that's just my son. It's not somebody being murdered. Um, in terms of what's changed for us, I think we're a big player in the embedded finance space more recently, and that creates a very interesting kind of dynamic when it comes to risk. So there's kind of an upstream and downstream implication of that, like how good we are at protecting against fraud affects our clients, and how good our clients are at protecting against fraud affects our brand as well. And that's only exacerbated with another thing that we focus a lot on, which is improving payment speed. And that gives us less time to share context and less time to react when we have bad actors kind of transacting on the platform. How we kind of focus on that is really to think about trust designed in before something breaks. So I always work with my team to make sure they're thinking about that. So it's not retrofitted afterwards. What are the failure modes? How do you think about that? And we really think about the integration and the touch point between us and our embedded clients. So we make sure that we're context sharing and then that's really deliberate because the more data we get, the better we can kind of combat fraud and AML. So yeah, that's a little bit about me. Really great to be here.
Awesome. Thanks so much, Peter. Really excited to hear some more of your insights as we get through this webinar. Again, thank you to you both for your intros. And so let's go into the state of digital finance through the threat lens. So I'm sure, as most of you know, physical branches are closing at an expedited rate. Roughly 6,000 FDIC insured branches have closed in the past 5 years, and that has been due to consumer preference. Consumers want speed, simplicity, and convenience, and digital-first banks and neobanks deliver that. As a result, they have become the primary financial relationship for many people. We're talking roughly 1.4 billion neobanking accounts worldwide and growing at 13% annually. And just think about that. At that growth rate, we're looking at 500,000 new accounts per day. So clearly this isn't niche anymore. And when you operate at this scale, expectations change. These banks are now being held to the same institutional standards as traditional banks. So any type of trust failure, like an outage, is no longer a minor inconvenience. It is a primary relationship failure, and it hits customers, it hits operations, and it hits brand reputation. DKB is a great example of a bank that has navigated this very well. Founded in 1990, they have grown into one of the largest digital-first banks in Germany. So Nikita, can you walk us through DKB's evolution and how the bank has scaled to manage that growth?
Yes, absolutely. And what we've seen at DKB basically mirrors the shift shown on the slide. So when I joined the bank 8 years ago, digital banking was already growing quickly, but today it's the default expectation, basically, right? So customers expect to open accounts online, move money instantly, manage their finances entirely through digital channels. So for instance, we don't even have any branches, right? So that growth creates opportunities, but it also creates or changes the responsibility of the bank. So when the customer interacts with you primarily through an app, like you said, trust becomes even more critical. And so from a fraud perspective, the scale changes everything. So starting with the transaction increases, we've had probably a 300% transaction increase in the last couple of years. Payment speed increases, and the fraudsters, they scale their operations as well, of course. So you can't just scale these operations manually or throw in more people or just rely on manual controls alone. So that's why I believe banks and especially we have invested heavily in machine learning and automation, also in processes, not only in fraud detection, but also in the post detection services. And the goal is not only to stop fraud, but to do that without creating too much friction for legitimate customers. Because ultimately, customers don't just judge us on the safety, but also on the experience they have with their banking.
Great. Absolutely. Digital today is the default. I love that you said that. And that is super, super helpful context. Thank you, Nikita. And so now let's go into the fraud surface. Today, banks and fintechs are leveraging tech like AI, instant payments, and interconnected products to drive the convenience that customers want. The challenge is that fraudsters are adapting just as fast. So, starting with AI, AI is enabling very convincing fraud at very low cost. I read a report noting that just a 5-year-old consumer grade desktop can generate convincing synthetic identities. And on top of that, agentic scripts can complete onboarding flows at scale. And these AI deepfakes are now bypassing identity verification systems, thus driving more account takeovers. Secondly, speed is accelerating the threat landscape. Instant payment adoption is growing fast, but these payment options compress the window from intent, so the why behind money movement, to loss down to seconds. And fraudsters are exploiting this because once fraudulent funds move, response options are already limited. And third, interconnected products are opening up new vulnerabilities, embedded lending, embedded buy now, pay later capabilities, for example. Each capability adds real value, but also introduces new cross product risks when fraud signals are evaluated independently across products. So, here touching on my second point around speed, Nikita, can you talk about DKB instant payments and how that has changed the way bad actors approach fraud? And with the changes, how have you approached safeguarding instant payments?
Yeah, so I agree that one of the biggest, or maybe even the biggest shifts is for us, at least, has been speed. So when you look at traditional payment flows, there was always time to investigate, or sometimes time to investigate or intervene or even recover funds after they have been transferred. So you had a much bigger margin of error. And instant payments have, of course, dramatically compressed that window down to 10 seconds, at least in the EU. And so today the decisions often need to happen in real time because of that. And once the money's gone, the opportunity to react is becoming very limited. So what we see is fraudsters, of course, adapting to this reality. They are optimizing for speed as well. So they try to move the money as fast as possible away from the customer using money mules, opening bank accounts in the name of legitimate customers, making it even harder to track down the path of the payments. And of course, as a fraud team, that means we need to be equally fast, but also very precise, right? So we're going to talk about friction, of course, but we can't simply just decline every payment that is suspicious because that would create a poor experience for legitimate customers. Whereas before we could maybe stop the transaction, ask the customer, and then approve it after maybe even a few days. So that's not an option anymore. So gathering right signals to understand the activity, or to understand whether the activity looks consistent with the customer's history is becoming much more important. And one of those signals can be, of course, device intelligence, right? So in our mobile app, we have strong device signals already by design because you collect much more data. But for instance, in the web banking or yeah, in the web channel, that's much more difficult, right? So solutions like fingerprint help us recognize whether we've seen a device already before with this customer, and that gives us, of course, an additional confidence when assessing risk. And I'm sure we'll come back to this point later when we talk about specific fraud scenarios, but that's the general picture we can draw right now.
This is Nikita. Yeah, that's a really insightful stat. The window, compresses to just 10 seconds in the EU to try to, for those instant payments. And Peter, with Sokin building embedded financial infrastructure for businesses, what changes to your product have you had to make because of the vulnerabilities that come with that interconnected model?
Yeah, so the biggest thing for us is that like interconnectivity, it doesn't just broaden the attack surface, it creates gaps at the handover points. And I think you mentioned it before about um, different companies making different decisions without the full context. And that's kind of where attackers can kind of exploit things. And that's exacerbated in this kind of interconnected world with embedded partners, etc. So it really used to be the case that you could generally rely on our partner does KYB, we do the payments, separate responsibilities. But these kind of sophisticated scams now mean that we have to treat the integration itself as a shared trust layer. And so we then become really opinionated about what checks we expect our partners to run. So some examples might be we think less about kind of document validation and more about behavioral analytics. So how quickly are they completing the onboarding form? Is there copy and paste behavior, device signals, same device across multiple onboarding entities? Those kind of things we find important, even though we're only doing the actual payment layer. And then we also rely a lot on trusted third-party data sources. So not just relying on what the customer or our provider is sending to us, but validating that externally so that it's harder to kind of fake information and it's easier for us to verify is the person who they say they are. So really, to kind of conclude, it's really about trust as a shared architecture across the whole stack. We've moved away from we do payments, partners do trust. We now have to work really closely with our partners and really design that integration layer to make sure both sides are getting the context they need to make the decisions that they need.
Got it. Thank you so much, Peter, for walking us through that. And that takes me to this next part. The rise in these technologies are leading to new risks, but where does risk concentrate first? Well, that's at onboarding, because opening an account unlocks access to other financial products with minimal friction after that point. Buy now, pay later type onboarding is heavily exploited because approval happens at checkout in seconds. To preserve seamless customer experiences, many providers rely on automated ID verification and database matching. These checks confirm that details match a record rather than investigating the data or the identity, behind them. And that is where the gap lies. Take a fraudster who finds a real social security number with no credit history. They attach it to a fabricated name and address, build up payment history over time, and construct a credit file. Now they have a record. They apply, the data matches, the check passes, they get approved. And fraudsters know this, which is why synthetic identity fraud is on the rise. Deloitte projects synthetic identity fraud loss will top $23 billion by 2030. So we have a structural problem here. These point-in-time checks only answer, does this applicant qualify right now, and not who is actually behind this identity. And generative AI and automation amplify the problem by making this scalable. Synthetic identities get deployed across multiple account types. AI-generated documents pass systems and get reused. Emulator farms simulate thousands of unique users to open new accounts again and again. And take those awesome sign-up bonuses many banks and fintechs offer to new customers. It's a very great acquisition tool, but to fraudsters, this is free money right away. And if an institution only has static checks in place, fraudsters can open up accounts in bulk and collect bonuses across all of them, which is, of course, incredibly harmful to your organization. And unfortunately, fraud does not stay at onboarding, it moves. An account that looked clean at onboarding can be a mule moving money by day 30. Every stage on this slide here is a trust decision for your organization. And the signal that helps your trust decision at one stage usually helps you at the next if you carry it forward. And I'll give you an example of a pattern. Take buy now, pay later, sees a spike in forgotten password requests. Each one looks like a normal recovery flow, but the same device is cycling through recovery on dozens of accounts, completing the resets, and then initiating purchases. No single stage looked wrong on its own. Only the same device ID showing up across the full journey reveal the abuse. And so teams that treat the customer journey as a series of disconnected point-in-time checks miss exactly this kind of pattern. So that takes me to my point that fraud prevention depends on continuity. Device-level intelligence, for example, provides insightful signals that persist across the whole journey. So instead of evaluating onboarding, login, and payments as isolated events, teams can see how activity connects and whether it reflects genuine behavior or patterns that signal abuse. So Peter, Sokin's platform is built directly into your partner's products. So the end user is interacting with someone else's experience. Given that layer of separation, how much of this customer journey can you actually see, and where are the blind spots that worry you most when it comes to fraud?
Yeah, so we obviously have really good visibility over the payment flow. So, classic screening fields like amount, frequency, counterparty, and the blind spots generally come in and are becoming increasingly important because of these newer fraud angles, particularly things like APP fraud. And it's for exactly the reasons you said, Emma, like it's harder for us to get access to that data because the customer transacting is actually doing that through a different platform. And so if you take something like APP forward, to us, it might look entirely clean. It's the right player, it's the right amount, normal timing. It doesn't flag anything from a transaction screening perspective. And that fraud is all happening upstream, so social engineering, spoof calls, fake invoices, which none of that in an old world we might not have seen any of that. And so what we are really working on is how we provide and get better access to that content, that context. So we work with our partners to make sure, A, that they're assessing those kind of things. We audit them and make sure they have the right kind of controls in place. And then we also build functionality to make sure that that context is provided to us as part of the payment. So we don't just ask for fields like payer amount and beneficiary ID, we're also asking for device level context and other pieces of information that help us make better decisions about whether that fraud is there. But this isn't a simple problem to solve. I mean, I saw some data today that like APP fraud is, 567 million last year, up 19% in the UK, and 88% of that was in scope losses, e.g. the banks reimbursed those funds. So it came out of the bank's cost layer. It wasn't us preventing fraud. So, a lot of money is still going into the hands of organized crime. And I think we as an industry all have a lot to do to try and get better at this. And it's only getting harder with some of the AI stuff that you mentioned.
Yeah, absolutely. And APP fraud is a huge challenge that I will touch on in a little bit. Thanks so much, Peter. And that brings us to the dilemma that I'm sure many people in the audience knows very well. Add friction to the customer journey. You might catch more fraud, you might not, but you will reduce conversion. Remove it, you acquire more accounts, but you could let in more fraud. So just applying more blanket friction may not be the answer. Our scaling trust report, which I will share the link to later, puts it clearly here. Legitimate customers feel the impact of friction first while attackers adapt. Over time, the organization pays more in decreased acquisition, increased attrition, and higher operational cost, while the fraud problem does not actually go away. So the goal is finding just the right balance of friction. Here's what it could look like in practice. A legitimate customer logs in from the same device in a new city and tries to increase their transfer limit. Individually, those are risk signals, but device intelligence returns a valid, previously seen device ID, no association with previously flagged IPs, and no overlap with fraud infrastructure or tampering present. As a result, the risk score stays low, the step up challenge does not fire, and the customer moves through without friction. And that is what is so valuable about quality device level signals. When signals are persistent, institutions can intervene selectively for high risk activity while keeping the experience seamless for everyone else. So, for both of you, could you talk to what has been implemented to help achieve this Goldilocks zone of just the right amount of friction for seamless customer experiences? And how do you decide when friction is worth introducing? And Nikita, we'll start with you first.
Yeah, I mean, I completely agree with everything you just said because the question I think isn't whether to add friction. The question is more where and for whom, right? So for instance, we're in constant dialogues with the product teams because I believe fraud prevention and customer experience cannot be treated as separate objectives. Because of course we're serving the same customer, and I think the example you just gave is really shows that, right? So my view on that is that fraud detection should be basically invisible. I often compare it to brakes in a modern car. So nobody thinks about brakes when everything's working, and nobody buys a car because they have great brakes. But of course, they rely on great brakes when there's real danger. And but if the brakes suddenly activated every 5 minutes when there's nothing happening, then nobody would enjoy driving the car. So I think fraud prevention works or should work the same way. And we don't want legitimate customers constantly prove who they are. We don't want to interrupt their holidays, like you just mentioned, or a normal behavior with challenges or warnings or manual reviews. And that's why it's important to, like you just mentioned, not only look at the transaction as a single payment or single unit, but to check the whole customer journey and to check whether the event basically fits into the history. And like you already said, I mean, adding friction doesn't really solve any problems, to be honest, right? Because legitimate customers will feel the frustration, um, but determined fraudsters they have a much higher threshold, and they will look for ways around it. So in the end, you're just punishing your loyal customer.
Oh, great. Yeah. Fraudsters, they're committed. They're going to try to get through that friction.
That's right.
Peter, over to you.
Yeah, I mean, just building on that. I mean, 100% with that's exactly what we see. Any kind of friction we apply normally doesn't deter the attackers really. So we generally take an approach of when we work with, our partners and our compliance teams and things like that is not to really question can we or can't we do something, but more to think about what's the data that you need to be comfortable with us doing that thing or providing that. So we don't really think about how do we control or stop something. What we do is what's the data we can get and how do we get it up front so that we can know whether that is a legitimate action or not. Because it's ultimately that provides us with the signals that we need, and therefore we can reduce any friction that we have to add. I think like one of the things I always think about, one of my biggest bugbears I've seen a lot in like neobanks and fintech lately is they always push, like if you take onboarding, they always push data collection right to the point of like greatest need. And they always do that because it's great for conversion generally. If you ask for a lot of information when I don't need to do something, then I'm less likely to give it to you than when I really, really do need to do it. But in a lot of ways, it's like the worst moment to ask because say I have a business client who's got an urgent invoice to pay and they've only just signed up. If we immediately ask them for a load of like UBO information, etc., that's like quite a stress-inducing moment. So what we generally try and do is try and get data as much upfront as we can. So whether that's directly from the customer or via third parties, so contextual signals, outsourced data quality checks, etc. And then that way we have everything we need to better understand that user and what they're trying to do, and therefore we can remove friction later on in the journey when it really matters, like where you've got some urgent payment to make. And when we think about that in an embedded context, that's really about what I mentioned before about that integration layer and making sure that it's really good at passing data back and forward. So we always have really good context on what's the user doing, why are they doing it, what context are they in, and that way we can like only apply friction where we need to and be like, very, very specific about when we do that.
Great. Yeah. And I will emphasize that data and signal quality is just so valuable. Thank you both for those insights. And I do want to flag something that we did touch on. One of the hardest problems for banks and fintechs to detect right now, authorized push payment fraud, APP fraud, scams where a legit customer is manipulated into approving a payment transfer themselves. Losses could reach $18.2 billion by 2028 if AI-driven scams keep intensifying. And like we've been touching on in previous slides, with the rise of AI, deepfakes are becoming highly realistic. So social engineering is becoming easier. Scams like investment scams, romance scams, losses are now very, very significant and also deeply personal. Here's what makes this so hard to catch. It's the person authenticating is the legitimate customer. They pass every identity check because they are who they say they are. So detection has to move beyond, is this the right person, to, does this action look like someone is being deceived? And that is a fundamentally harder question to answer, but we will get into it. I'll narrow down on some additional questions for Nikita and Peter. And so on that topic of APP fraud and the challenges that social engineering brings, Nikita, how do you detect risk when the customer is the one approving the transaction? And for you, what signals do help this challenge?
Right. So I can absolutely confirm everything that's been said. The trends we're seeing exactly like you described, and I believe that's one of the most interesting shifts we're seeing today, because historically, most fraud cases involve some sort of or some form of account takeover, right? So the fraudster would try to gain access into the account and attempt to perform actions as the customer, right? So try to initiate and authorize as themselves, basically. So from a detection perspective, those cases are relatively straightforward because there are a lot of technical signals we just discussed. We can see it's a new device or whatever. But as a result, fraudsters have adapted, of course, right? So we've talked about all the methods before they move towards social engineering and scams. And what we're seeing right now is a great influx of fraudsters calling our customers and pretending to be bank employees or technical support or another trusted party or someone else, and convince the customer to authorize the payment. So in those cases, like you just mentioned, it's not just enough to look at the authorizing device because, of course, it looks genuine. So one example that we use is we check for the difference between the two devices, basically. So what we're seeing is the fraudster is trying to initiate the payment through maybe another channel, maybe the web channel, and then talks to the customer on the phone and then convinces the customer that they're being hacked and that they're trying to help this person transfer the funds to a safe account. And of course, so the customer's very upset, very nervous. So they're basically taking advantage of this situation for the customer. They, of course, have gathered all information prior to that. Maybe they fished some information. Maybe they've taken stolen credit card information, and they can basically authorize themselves to the customer through that. So there's trust. There's a trust relationship between the fraudster and the customer. And so what we can do, or what we do is basically we try to check, first of all, of course, is this device known to us? The initiating device, like I mentioned before, the fingerprint maybe can be a factor. And the most important thing is, do the technical data of the two devices have something in common? So, for instance, the distance between these two devices is a very telling signal. And through that, we can basically detect these kind of frauds. But of course, again, here they also adapt pretty quickly. In the past, they've been always using connections from maybe Asia, Africa, and we're seeing shifts from these kind of places towards Europe, towards even the country of origin from the customer. And I personally read reports where I've seen that many fraud farms are not only located in maybe India or Asia like they're used to, but they're moving even the people to Central Europe. So it's becoming much harder to detect. Yeah.
Yeah, thank you, Nikita. Really appreciate that and appreciate the real world example. Definitely, we all find that very valuable. And the theme of this webinar, we've been saying, fraud tactics are becoming more sophisticated, especially with the rise of AI. So Nikita, again, what capabilities do you think banking teams will need to invest in next?
Right. So what we just talked about, the authorized push payment fraud, like I said, the fraudster is initiating and the real customer is authorizing. So we still have some sort of technical data we can look on. I think that's really helpful, even though they try to mask even more data. But what we're also seeing is, in my opinion, maybe even the next level, right? So, like you said, maybe with the use of AI tools, or maybe not, I don't know, um, the customers being coerced to not only approve the or authorize the transaction, but also to initiate the transaction. So, I think one of the most classical examples everybody knows is the AI voice clones. So, where basically your daughter, son, whoever is calling you for help, needing money. I think these are the classics, but also, of course, fake invoices or fake investment scams where the customers fully convinced that they will have they, they will make a lot of money. So these kind of transactions are, of course, incredibly difficult to detect, right? Because from a technical perspective, everything looks perfect. Everything looks legitimate because there's no fraudster involved in a technical sense. Vice is known, login is successful, payment approval is successful. So if we only look at traditional fraud indicators, there's very little we can detect. So I believe, and Peter touched upon this in the beginning, that we will need to invest much more in the future in deeper behavioral understanding. So instead of just asking, who is this, we will be asking, does this behavior make sense for this customer? Does it fit their historical patterns? So, like you mentioned with the person on holiday, maybe they've been to this country many times before. Maybe they never leave their home country, and suddenly there are payments there. I believe that we need to take these factors much more into consideration and detect anomalous behavior. That is from a behavioral standpoint and from like the customer journey. And I believe what is even more necessary in the future, and Peter also said that already, is the technical behavioral analysis. So, for instance, there are vendors who provide technical data to detect behavioral shifts. So, for instance, you can tell, is the transaction being typed in, or is it being copied and pasted? What is the pace of the typing, the strokes, the clicking, the hesitation, and then you can basically derive from these signals whether maybe the customer is being coerced into doing something they don't want to because they're acting nervous, and it doesn't fit the behavioral pattern we've seen before in legitimate transactions.
Yeah, that AI clone scam is insane. I've had that happen to me before, where a fraudster pretended sounded like my mom and called me. But, yeah, it's crazy now. And Peter, over to you. Earlier in the webinar, you mentioned that embedded finance companies can inherit another platform's brand risk. So, what does that mean in practice?
Yeah, so if you think our infrastructure lives inside our partner's product, and so the end customer who's actually transacting rarely sees like soak-in. And that leads to kind of risk flowing in both directions. So one way is when something breaks. So say we have a failed settlement or a painful RFP process off the back of a transaction. that's going to hit the partner's brand more than it hits ours because they are the ones having to deal with the customer and trying to understand what's going on. But it also runs the other way. Like, so if our partner doesn't onboard particularly well and they onboard a load of fraudulent accounts, then we have problems processing payments on behalf of fraudsters, and the regulator comes after Soken as the regulated party. So we're both kind of bound by this sort of trust issue where we have to kind of work really together. Um, I think a good kind of example of that is like a suspicious payment where we need more information, how we handle that process and how we like what information we request, what information we had in the first place, how the end customer actually gets asked about that information. That matters to both of us. And so um we need to work together and have that integration point as being a trusted architecture. I kind of talked about this in terms of what information is shared, how are anomalies surfaced, how transparent are we? And if we can get that right, it means we can protect our customers and not create friction that hurts the partner's brand. And that's how we create, that's why we work really closely with our partners to make sure that we're being really clear about those handoff points and and creating a really strong relationship so that the end customer gets a great experience and the regulator's happy and that we're not processing loads of fraud.
Thanks, Peter. And for product leaders building embedded payments experiences, I'm sure you can give some great insight here. What are the trust questions they should be asking before they scale?
Um, so from my perspective, I kind of think about it across like three rough questions. So I always think first, like, what data are you getting is normally a big question I ask my team. So are you getting full payment journey visibility? Are you comfortable with what you're inheriting from the partner onboarding? How are you making KYC decisions? What's the pre-transaction context that you're getting? And then I'll normally talk to them about, okay, well, how are you getting that data? Is it manual? Is it via API? Is there some other mechanism? Because that affects how quickly we can respond to that information, how dynamic we can make the experience. And then the big one, and probably the most important, is how are you handling the non-happy paths? So I often think like generally human beings have this tendency to only think about what success looks like and the happy path through that. But actually, in reality, it's the non-happy paths where you end up with a really poor experience if you don't actively think about that during the design phase. So when an issue triggers, what does the customer have to do? Who contacts them? How does it get resolved? That's really important to get that right. So like, I've worked at places in the past where we've had, something like that happens. We email the client, they don't know what to do. The customer takes ages to respond. There's lots of back and forth. And that's not a very seamless experience. It's a lot of friction and it isn't really protecting against the underlying fraud. So I think like handling those non-happy paths and designing that experience seamlessly is really critical. And that's how you can kind of get back to that Goldilocks zone of finding that right balance between friction and fraud.
Great. Sure. Any product leader building payments, building embedded products, those questions to ask are all very useful and valuable. Our final panel question for you guys. It's open to you both. And Nikita, we'll start with you. What kinds of detection are most helpful when both product and fraud teams are trying to make better decisions together?
Yeah, I mean, we've talked about a lot of technical signals today, and I think what Peter just said is sums it up perfectly, right? So I think the most helpful thing isn't really a detection capability per se, but it's involving the fraud team much earlier in the product design process. So more often than not, products were designed around the ideal customer journey, like Peter just said, and then maybe from a UX perspective, nobody thinks of the happy path as well, but also from a fraud perspective, right? Because product doesn't really think about these kind of things. And the problem is that security measures are introduced late, and they tend to create friction because of that, right? Because they're compensating the risk that the risks that weren't considered from the beginning. And I think the best outcomes happen when fraud and product teams were working together from day one. And a good example is maybe authentication, because rather than just simply adding another challenge that is basically the same type of challenge. So if I already have taken over the account as a fraudster and I have put down my biometrics, and then I have to authorize the payment with Face ID, that doesn't really do anything, right? So um, we should try to introduce another challenge that the fraudster can't really easily abuse. So, for instance, a factor that only the customer has physically, like the card, credit card, and then that can be maybe read from the phone to authorize the payment. So I think there are a lot of different examples we can take, but that's, I think, the key. It's not something that's bolted onto a finished product security or fraud detection. It should be designed from the customer journey from the start.
Great. And Peter, can you share some insights here too?
Yeah, I think what you said there, Nikita, around it not really being about like a specific detection field or detection point that's like particularly valuable, and it's more about how you understand the whole experience is right. We always think about ultimately in any transaction, there's kind of two places to intervene. There's the sending side, so how does that person get onboarded, log in, view, create, send that transaction? But then there's also the receiver side. And again, how does that user log in, view, receive, understand? And I think you have to kind of look at both of those. So on the sender side, you're thinking about, is the behavior out of character? Are they using a usual device? Are they in a weird location? Does the session history match what they usually do? On the receiver side, they're looking at like, has that person onboarded multiple accounts in different places? Are there onboarding patterns that we might have missed? Does it look like a real genuine business or consumer? And I think gone are the days where like transactional level detection is what you can rely on. Generally, with sophisticated fraud scams, it's already the fraud has happened by that point, and the payment will generally look quite clean. And so it's not really about the payment anymore. It's that whole journey approach. I think we talked about it before, Emma, right? Like every stage generates a signal, onboarding, login, session behavior initiation. It all comes together. And I do think like as much as AI is creating lots of fraud problems, it also is an opportunity for us to fight the fraud. Like it gives us this ability with machine learning to look at way more data than we were able to look at before. But look, honestly, like there's no golden bullet, I don't think, to this stuff. And it's always moving and changing. The industry is generally still not that good at this. The UK numbers that I showed before, we've got better at is reimbursing clients. We haven't really got better at stopping fraud. But I think, there's more we can do, and that I'm hopeful that the kind of sender receiver side framing and the ability to use machine learning and AI to look at a lot more data and match patterns more easily should really help us start to target some of these advanced scams that we're seeing these days.
Thank you. And I did want to share too, we talked about it, offline a bit, providing awareness too,
Yeah.
educating your customers is key and can certainly, assist in mitigating fraud. Because, if they're not in the industry, they're not quite aware of all the scams that are taking place right now.
Yeah, you're right. I'd forgotten I
Yeah,
was going to say that. But yes,
yeah, yeah.
it's really true. Like there's so much, and I do think this is where it's getting a bit better. Like we live and breathe this industry all the time, and so like I'm always suspicious when anyone phones me because I kind of know what things might happen. And I always remember like the first time I bought a house, and I was very conscious of like the emails I got from the solicitor and any bank details that they passed around because I was very conscious of what could happen. And I think there's a lot of more education we can do for people that don't live and breathe the industry. So that I do think sometimes understanding what the risks are makes you a lot more aware and think about, actually, is that my mum who's phoning me? Or does that sound quite right? She doesn't normally phone at this time. Like maybe I'll hang up and call her back. Like just little things like that to help you out. So yeah, the education piece really matters.
Awesome. Well, we do have some time for Q&A, but I did want to just share first, Fingerprint, we do have a report on this topic. You could scan the QR code right here with your mobile phone. It'll direct you to the report. It digs deeper into the banking landscape, into fraud, the neobanking scale numbers, synthetic identity and APP fraud, and of course the shifts from point in time checks to continuous trust. We'll drop the link. I can drop it in the chat as well. Yep, I will leave the QR code there for a little bit longer. I will just I'll drop the link in. We'll move on to Q&A because we're almost at time here. So if you guys have any questions, feel free to pop them in the Q&A portion of this webinar, in the webinar screen. We'll see. We have one here, Peter, for Sogan specifically, when fraud occurs inside an embedded product and the end customer is your partner's customer and not yours directly, who does own that response?
So it's honestly it's like a joint response. Like it also, the generally our partners dealing directly with the customer, but we are the regulated party, so that any kind of long-term fraud or anything like that, the regulator and if the law enforcement's were to get involved in anything, they would come to us first. But it's a combined kind of approach. We have to work really closely with them. We have certain agreements and obligations between us where we decide who's doing what and how we're going to handle that and where the liability sits. But yeah, it's very much a kind of joint piece of work, and it's why we have to work really, really closely with them and really understand. We spend a lot of time understanding the steps that they're taking to make sure we're comfortable with those steps and that they're kind of satisfactory enough for us to make sure that anything that we process and transact is kosher.
Awesome. Thank you. And there's one here, Nikita. This seems directed to you. How do you navigate different Euro regulations, and specifically where regulations may have helped you move fast on fraud, and where has it gotten in the way?
Right. So, as most of you probably know, the European Union is very good at regulating stuff. So, from a European perspective, we have the PSD3, it's Payment Service Directive 3, and the upcoming PSR. These are the most relevant developments, and it's a regulation with strong focus on fraud prevention and customer protection, which is good from a customer perspective. Of course, it's a lot of work for us. I think what's positive is that it's encouraging much more collaboration and data sharing across financial institutions. So historically, each bank or all the financial institutions were very hesitant to share data regarding fraud or regarding customers. Of course, data protection and everything, and maybe even it's a USB. I don't know, but fraud, of course, doesn't respect these boundaries. So I think that's a huge win for the customers and for us from the fraud side, because basically that's another pool of data, external data we can tap into right now, and which is not only required through regulation, but also it thrives through that. The other side of the coin, though, is the liability. Peter mentioned the reimbursement. So before the new regulation that will be in effect from next year, I believe, if a customer authorized the payment, the responsibility often was relatively clear. So we could just say, I mean, you authorized this payment, you were responsible, and that's it. But this whole scenario flips. So we have to identify scam scenarios much earlier. We have to reimburse the customer more quickly. And for instance, this scenario I mentioned where the fraudster is calling on the phone and pretending to be a bank employee, this is a specific scenario that is even in the regulation where the bank is liable. So it goes very deep, right? So I think the incentives are changing for banks or financial institutions. So fraud prevention is not only something that you do internally and you basically just do whatever you can or want, but I think through this regulation, I think that's healthy, for the industry because it creates stronger incentives to invest in better detection. And after all, we're all customers somewhere, so I think that we all benefit from that.
Absolutely. Appreciate that insight. Not seeing any more questions in the Q&A. So well, I think I will move on to our final slide here.
Awesome. And that brings us to the end of today's session. Emma, Peter, Nikita, thank you all for walking through those really great insights. To everyone who's joined us today, if you would like to revisit any of the topics we covered, you will receive a follow-up email with the recording and also a copy of the report that Emma touched on right at the end there. So thanks again for joining us and have a great rest of your day, everyone.
Thanks all.
Thank you.
Cheers,
Bye.
everyone.